Hi there, traders. This is Brad Gilbert. Now, just in our series of coaching sessions, just want to run through trading FX options, right? A quick beginner's guide. Now, let's just start with what is an option, right? It's exactly what it sort of says it is, okay? Options are financial derivatives that give the buyer the right, but not the obligation to buy or sell the underlying asset at a stated price within a specific period. Right, so you have the right, but not the obligation, and the whole sort of ethos of selling options and the options market is it sort of takes out, the so-called risk. But I tell you what, there are some other things to consider, and it's the upfront premiums, right? But this is an actual fact. You can actually make much larger incremental gains with huge bets, right? They are more bets, based off what. You know about the sort of direction and trends and economic numbers and central banks and all these sorts of things. But realistically, they are sort of trades, but the leverage that you apply to them makes them sort of huge bets on the outcomes. But one thing to just be aware of, they can be huge money pits, right? People think, oh, I love trading options, but you know what? 99% of options go unexercised. Right? We tried to run through options as part of the program many years ago. It confused so many traders, we took it out. But you know what? Things have changed. Maybe it's time to bring them back in, because if you know how to use them properly, right, you can leverage up in the market, especially when you're making money. And that's when they can really kick in. All right, let me just run through the basics here. Now, there's two fundamental types of options, right? There's the calls, an option to buy, right? Usually above the market. And then there's the puts, an option to sell, usually below the market. Now, how are the options valued, right? This is important to understand because it keeps you focused on the key things that you need to be aware of, right? Time value, the time to expiry, the level of volatility in the market or to be expected, the strike price, how far from the market price is your strike, and the direction of the instrument, okay? Current direction of the instrument will impact its value. Now, I'll come into that later on because it's very important. It could be a strategy around reducing the cost of the option by looking at all of these various factors. Now, the cost of the option itself, it's called the premium, okay? Now, the bankers our guys used to use the Black-Scholes model. They'd pump in all these numbers, they'd adjust volatility and a few other bits and pieces, and then start spitting out some prices, right? So depending on the relative risk appetite of the options dealer, you could get very varying prices for the same strike option. Now, as soon as you buy an option, we get time decay, right? It's like when you buy a car, okay, or any sort of asset, there's time decay. But with options, it is pretty explosive. So when you go to put on an option, you need to know where your strike price is, the likelihood of it getting there, and that'll obviously be reflected in the price of the option, because as soon as you hit the go button, time decay, the value of that option starts to diminish very quickly. Now, let's just look at, say, the strike price, right? There's three types of strike prices, and I'll use an example here of a call, right, where you're a buyer. Okay, so the first one, at the money, right, at market. Right, so you can buy an option straight at the market and go, you know what, I want to have a call option to be long here at the market right now. There's, in the usual, like strike prices, are OTMs out of the money, right? In this case, because we're looking at a call above the market, your strike would be above the market. And that's one way, obviously, to reduce the price of the option. And last but not least, okay, you could have the market price, say in euro here at 107, you could buy an option in the money, right? Which is, a little bit rarer because you're trying to sort of use options to leverage up. And to do that, you can reduce the price by having a strike further away from the market. But if you want to buy something that's already in the cash, well, you can, but you're going to pay a premium for it. And these ones are called in the money. Now, looking at those three types of strikes, right, the time decay is not linear, okay, for all of these things. Okay, at the money, right, it's more of a curved, out of the money, a direct line straight down, and in the money, lower time value, but obviously all got the same time expiry, right? So it's obviously important. I've never bought an in the money option. Okay, out of the money, 9.5 times out of 10. At the money, sometimes. If I had a massive position and there was a big data release coming out and I needed to buy some protection over the number, well, that's when I'd buy an at the money. But it's an expensive stop loss to stay in the game. Now, when we are considering options, okay, now there's two things. You can buy an option to leverage off the position, or you can buy an option and trade it, which means you could buy a call or a put and then sell that buy or call back in the market in a couple of days if the value of that option went up or down. Or, as I said, you could leverage up and start hedging the positions. So the trend and momentum is important. Short-term momentum, long-term trend. You want to get the timing of these two aspects of the market to make sure you get bang for your buck. Because if you go into the market when there's no significant chance of a change in trend or no significant change in momentum, well, time decay is going to eat your option alive and you won't get the move to get the value out of it. And this is where the economic events are critical, right? Now, going back to when I first started trading in 1990, options were a huge part of our strategies, right? And as time has gone on, a lot of the team were getting destroyed on options, because they were trying to leverage up on the major events. But if you just go in and focus, say, on core inflation in the US and you're buying options before this release, the option value, the option traders love this, right? Because the option value, because there's so much demand, it goes through the roof, right? And you can, if there's no significant change in the data, well, you know what? That's just a dead trade and all the money you've spent on that option is gone. But if you use it properly, leverage up, get the timing right, and you do get good outcomes, well, you can see how you can make huge incremental gains. All right, let's just look at strategy one. Use as an entry level, right? In this example, I'm just looking at a put, right? The option, the right, but not the obligation to be short below the market. Now, if the premium is 10 pips, that means your break even is 10 pips below the market, right? Don't forget, premium equals the cost, right? And usually with most options, our guys we could either do it in a cash amount or a pip value. So market pre-release, above the market, you've got a support trend line. So your strike price, right, is below the market. It's a put, okay? So you're looking for a order here, 55 points below the market, right? And for that right to be short down there at 97.35, say it's in 1 day or 2 days or 3 days, right? It's going to cost you 10 pips. So all you need is a move 10 pips below that strike price and you're at break even. So you can start to see, if you start to see, well, the chance is for a big move to the downside, then you know what? 10 pips isn't much. Might get you into the trade, avoid the execution risk around some of these high impacting releases. And this is where you have the flexibility, right? You can watch the market. There's no need. You can either take profits in the market and hedge that position, right? You'll be short at that strike price, and you can buy, say, half the position at take profit 1 and the other half of the position at take profit 2. Then if the dollar index in this case goes down through those levels and back up above the strike price, well, you can sell those positions and the option is still in play, and you've unhedged the position and you've locked in profits already. Okay, so what it does is it takes out the need for a stop loss, okay, having an option in play. And the risk here, well, it's just the cost of the option. In this case, it would be 10 pips. Now let's look at strategy 2. You can use the option as a stop loss. Okay, same situation. We're looking at a put, right? So in this case, the strike price, it's below the market. Sure, it's a put, right? If the premium was 10 pips, your break even is 10 pips above your entry. So in this situation, right, you see the dollar index starting to fall, and it starts to stall around the 97.50 price. Well, in that case, you can actually choose to go long, right? You can actually buy and use your option here as your stop loss, like you would with a normal position, right? And that gives you the flexibility if it does start to move up, right? Well, you've only got to make 10 points and you've covered the cost of the option. And then if it goes back down, well, then you could let it go, right? So you can use the option itself as a strike, as the stop loss. Now, in this situation, right, say the price of the dollar index went straight down here, right? Well, when it comes time for the option to expire, you would exercise the option, and that would make it a physical position, and you would close out the loss between where you went long, okay, and the option strike itself. All right. So in this situation, though, there's a bit bigger risk, right? You've got the cost of the option plus the size of the stop loss between where you went long and the strike price. Okay, now let's have a look here. So they're the sort of two aspects of how you trade options, right? Use one as an entry or use it as a stop loss, depending on what's going on. Now, there are, if you know what you're doing, there are sort of strategies around reducing the cost of the option. Now, the most simplest one would be to lower the strike price. Okay, say we're looking at a 10-point premium or cost with the strike price around 97.60 here, 30 points below the market. Well, if we lowered the strike price down to 20, right, you might be looking at only 5 pips or less. Okay, so it's one way to reduce the price is to lower the strike price. Okay, lower it down. And why is it cheaper? Well, the probability of that option getting hit and coming into play is reduced, right? So there's a lower price for it. And that's one thing you can do. Now, I wouldn't be doing this. This is where a lot of people get confused. You wouldn't be lowering the strike price if you didn't think it could get there, right? And what I'm talking about is if you see say an hourly chart breaking down, but it's also breaking through the daily chart, the longer term trend, well, there's a potentially bigger move there. And that's when lowering the strike price might be a good thing, especially if there's a high impacting central bank announcement, because you know what? You can reduce the cost of the opportunity by lowering your strike because the potential is actually there. Just the rest of the market hasn't recognized it at this point. Okay, so now another way to reduce the cost of the option, right, is to buy calls, okay, as an example. It could be also puts, when the market is moving against the opportunity. Okay, so what you would be doing is looking to buy calls when the instrument is going down. Now, if you're buying calls up here, right, they're going to be cheaper, especially when the market's hammering to the downside. Okay, this is about the direction. So a lot of the times when we were looking for opportunities during the day, say it was a short-term economic data release that wasn't really going to impact the trend, we would wait for it to hit. And once the market started falling very quickly, the value of that option would diminish, you know, by more than like 2/3, right? So and then when the market stabilizes and comes back, you've got an option that is very cheap, but you've got to understand and realize what is there a chance for this to bounce? Once again, going into that opportunity, when the instrument is under pressure, right, it can be quite foolish because it could just drop away. And this is where understanding the short-term, long-term trends and the impact of the economic numbers, whether it's going to be shorter term or medium to long term, is important. Okay. And you get that move down. Obviously, buying out of the money calls is the way to go in that situation. Now, I'm talking at the moment about vanilla options, right? Simple calls and puts. Now, there are a range of other options here or ways to reduce the cost. right? One is a simple, and this is probably one of the most simple strategies, buy a call or put spread with the same expiry, okay? Now, what that means is, let me just get my pen. You buy an out-of-the-money call above the market, right? So that's great. That'll cost you a bit of cash. If you're buying it when the market is going down, it'll be a little bit cheaper once again, right? Combining a few different strategies. And then secondly, on the same expiry, you sell an out-of-the-money call above your first option, above your first call, right? So, and quite simply, what happens is, ideally, you want the market to come back up here, above the market. If it goes above the option up here you've sold, well, you've covered it with the first option, right? So there's no risk above the market. This is the money you're going to make, right? If the instrument rallies back above the first out-of-the-money call. And this is the same for the puts, right? So the idea of selling an out-of-the-money call above your first one, right, is just to reduce the cost, right? So for instance, this first one costs you, say, 20 pips, right? And the second one, well, you might be able to sell that out-of-the-money call for, say, 7. So the first one here, the whole structure costs you 13 pips as opposed to the full 20, right? It's one way to reduce the overall cost of the option. All right, and that's quite simply how options work, right? As I said, there are other structures where you could buy, say, a call on the top side with a strike entry, a lower strike entry below the market, right? So you need a dip and then for it to rally. You can add all sorts of tricks in there. They'll price it up for you, but obviously the more complicated you make it, the less likely it is to come to fruition. All right, so now this is where your knowledge of the markets comes into play, and the monthly cycle of fundamentals is very important. Okay, week 1, very good. Week 2, very good. You know, week 3 can be average. Week 4, generally poor. Okay, and then back to week 1, really good. And that's because the key in the first 2 weeks of the month, we get all the big chunky numbers, especially in the US. Okay, the best and most important each month, key US directional macroeconomic data, the labor market, and inflation numbers, more often than not. Okay, and these provide huge potential moves, and not just potential moves, momentum, also moves that will run very aggressively with the trend, or if the economic circumstances are changing, can alter the trend very quickly as well. And that's where you're going to get the big incremental moves. So the time to the move, okay, this is where you've got to really sort of think about it. And as I said, without any experience, you can end up spending a lot of money here. Now, time decay, it's our biggest enemy. So you want to avoid the weekends, right? That's 2 days of time decay. Sometimes if you've got an option that rolls over, say, a week or 2 weeks, well, you can't help it. But what you can do is try and make sure you don't have multiple weekends unless you've got a massive long-term structure. Understand Fridays are more expensive. No one wants to hold the positions over the weekends or pay the cost for the weekend, okay? And usually if you've got non-farm payrolls, those sorts of things coming out, the Fridays are going to be a lot more expensive, okay? So you either want to be a part of that opportunity to get into that trade or not, okay? But just understand you're going to be paying a premium to have your option expire on Fridays. And you can usually choose your time, right? 10 a.m. New York, 1 p.m., 2 p.m., depending on the option trader. Now, generally speaking, what I would be doing, you're looking to time the option. Now, if you're waiting for a key economic number, say you had, say for instance, the US CPI numbers were coming out Wednesday, right? Well, I can tell you, no one on the Friday before, people will probably avoid buying the options. But when it comes to Monday, they'll probably jump in. If you wait till Wednesday, say 3 hours before the release, the price of that option is probably going to be double, if not triple. So you've got to try and factor in, pay a bit more for the option and try and get in it like 2 days before the market starts to move on that opportunity. Okay, it's a great way to get into the option. And if it starts to move your way leading into the data and you get the result, well, there's your massive cash return. Now, the other thing is the options. This is what a lot of traders like, is it removes the high execution risk around some of the high impacting data releases. But don't forget, you're paying for that release. Okay, so like I know a lot of people go, you know what, I'm going to trade options because I can't handle the high execution risk. But you're going to be paying a premium if you're just trying to avoid the execution risk around these events. Okay, but you can do it by buying options. It is a way to reduce that risk. But as I said, it can be a massive money pit, right? There's cash in it. You can see the opportunity. But you know what? If you don't get the numbers popping out the way you like, right, the instrument isn't going to move. And all of a sudden, time decay is your enemy. And if it doesn't move far from the strike price, especially in the direction of your option, you're going to be left there nursing a nasty cost. Now, one thing I've spoken about on some of the daily market insights are risk reversals, right? Now, this is a way to basically track the activity in the options market, puts versus calls. Okay, so when the markets dip, okay, like you see at the moment here, there's a big spike down. The market is rushing into puts. Now, that could be a bad economic data release, a comment from a central bank. The market is covering their positions. But when you start to see situations where the markets are going up, like we do over here on the right-hand side, and we've got 1 month versus 3 month, right? This is like an hourly chart overlaid with a daily chart as far as your technical analysis. If you see both of them moving it sort of in the same direction, you can be very confident that that's what the overall market expectation is. So when they start going up together, you can expect that instrument, and this is euro, to be going up. So the market is expecting a move higher. They're buying more calls over puts is what it means. Okay, so when it goes down, they're buying puts over calls. And this is a great way to check, okay, if you're looking at your charts, your hourly charts versus your daily charts, let me just do a bit of a cross-section here. What are the risk reversals telling me? Okay, in that situation, it can save you a few bucks by looking at it that way. If I just come back and you have the same situation here and you see the market trading sideways, well, the market's not sure, okay? They're buying puts over calls one day, they're buying calls the next day, and you know what? Overall, it's just trading sideways. What you are looking for is a sustained or a continuous move, and that usually coincides with a major economic fundamental release and a shift in the market trend, which is what we're seeing at the moment. So options, right? The pros and cons. Okay, now this is very important because companies that run option programs, right? It's an easy sell because you're selling the dream, make millions, you know, with 10 grand, all this sort of stuff. But you've got to understand there's a couple of key things. Now the pros, where they obviously leverage up off the product, you can leverage up significantly. For a small outlay, you can seriously leverage up, right? Especially if you know how to try and reduce the cost of the option, high strike, buy calls or puts against the market direction, these sorts of things. And if you get it right, you can make, you know, seriously like 10 times more than you usually would out of a normal trade. You can take out execution risk. That is an actual fact. No need to worry about getting in at critical levels or high impacting releases at the time, right? So, but don't forget, and this is where people feel relaxed. You may have paid 5 or 10 grand to take out that execution risk, and you're weighing up one versus the other. Okay, it's something to consider. Now, there's multiple strategies. Okay, with an option, as I showed you, strategy-wise, whether it's a call or a put, you don't have to be stuck with the strategy, right? So you can be flexible. So if you've got a call, you can use it as a stop loss, or you can use it as an entry level. So it really comes down to what you can see happening in the market. And if the market is changing very quickly, well, then you can adapt as well and get value out of the option. Now, the cons, well, they can be seen as a waste of money. this is a fact, right? 99% of all options go unexercised. That means they aren't triggered. Okay, so you've got to understand that. Now, we used to know this fact, and my budget near the end of one of the banks I was working for was about somewhere around 6 or 7 million US I had to make a year. Now, I would generally hit the target. I would generally have a cost of my option price or spending on options was about 2.5 million US, right? So I'd make 9.5 and take out the option cost, and I'd be left with 7. But that 7, probably I'd say at least I'd say a third of it was put down to good option trading. So even though you're not exercising them, right, they can still be a huge value. But for most traders, retail traders, they go unexercised. They don't know where to position the strikes, how to reduce the price, get the timing right, all these other components. They can be expensive. If you're just going in to try and cover execution risk around a key event, right? Well, you know what? The option traders will factor in, what they think the volatility will be around the release, and they can actually charge you whatever they want, right? So they can be hugely expensive just for you to take a little bit of pressure off. Sometimes, and a lot of the times, it's easier just to get into the trade, isolate the best trading opportunity, and nail it that way. Time decay. This is your killer, right? More often than not, by the time the option gets back to your strike level, you've run out of time and you've lost the value of the price of the option. You've just had to swallow that up. Now, there's one other thing I was just going to talk about here was looking at if I just come across here, actually looking at where the options, what happens to big option structures? Okay, now, if we're looking at big option structures here, let me come over to the daily charts. So the markets generally gravitate towards the large option strikes, right? This is what can happen because there's so many strikes around. If I just get my pen up here. Okay, so looking at the dollar index, right? We may have, and you get them at really big round numbers. Say we're looking at 100 on the dollar index. Now, as the price goes down and gets right to close to the time of the expiry, say there's like a couple of $1 billion worth of dollar calls or puts, in this case it'd be puts, on the dollar index around 100. Now, as it gets closer, there's two things that are happening. The person that holds the option, right, they're going to be short, right? So they're going to be buying below the market, trying to get value out of it. The person who sold the option, right, they're going to be long. So they're going to be trying to either hold it above the market, or sell below it. So you get this sort of tug of war happening in the market. And what can actually end up doing, if there's a massive option on a certain day and it's close to a big round number, you can actually get the instrument gravitating towards it and not moving off it, right? Until the expiries are done. Everyone's sort of cashed in. The guy who's short, who bought the option, he's buying. The guy who's long, the trader, he'll be selling. And generally what happens is there's a massive transactional flow of exchange of buying and selling between the option traders, the people who hold the options, and the traders themselves. And that can actually dominate market activity around that release, especially if there's no economic numbers, right? It happens across the board on all instruments, big round numbers. This is why a lot of the time when we talk about having looking for big round numbers, it's not just the significance of big round numbers, just because they've got, big hairy numbers around them. Like if I look at euro here, right, 110, right, it's 1.1000, right, a big level. So that's where a lot of the corporates use to protect positions or to leverage off positions. They use big round numbers for all their strikes. And that's why when we talk about a change of a big figure, say from 110 to 111, you might get a double whammy here where you've got let me just clear the screen because that's probably a very good example of you've got a big round number. So it might have option strikes there and also a big technical level. And you know what? You get an economic number here, it'll blast through and the option activity there could be quite explosive. especially if it's a couple of days before the expiry, because the person with the option will start buying, that the trader that sold the option will start buying to cover, because he's now short above that level, and it can trigger very big moves, right? So if I was looking at a potential opportunity here and a real one, it's probably looking at the daily trend line here on euro. As it gets up towards that 111, start looking at what economic numbers are coming out. Okay, if we start to see further weaker US numbers and you're not carrying positions over the weekend or a Friday, then you can see a potential huge move here, because not only is it breaking a technical level, it's breaking a big round number, which is going to probably include a huge amount of option activity. Okay, now that last part may take a bit more explaining, and I didn't want to get too far into it, but the key part here is just so you understand how the options work. Okay, what are calls, what are puts, what strategies can you use, and where's the value in them? All right, guys, I hope that helps. Any questions, jump on the Discord and I can help you out. Cheerio.